Well, let's get across the market open. Kyle Ryder joining us from capital.com out of London. Kyle, welcome. Welcome to December. Here we are now. In fact, particularly equity markets are very much still focused on the prospect of a rate cut in the States.
Yes, and I think that's basically the whole story at the moment is effectively that markets are moving in tandem with the changing expectations of a rate cut from the Fed in a couple of weeks' time. And, obviously the uncertainty surrounding that, and more or less the markets are now pricing in a sort of 86, 87% implied probability of a cut. Could potentially be a bit of a fatal conceit because really that was on the basis of just some, dovish language from a couple of Fed officials a week ago. And, the lack of data that we've got to really, at this point in time, push back on any notion that the Fed shouldn't cut interest rates explicitly just because of, obviously the fact that we've had a dearth of information, a dearth of data, because of the knock-on effects of the government shutdown. Lo and behold, equities are kind of, basically moving higher on that prospect. Like I said, it could be that this is a bit of a fatal conceit and, the markets come to doubt the prospects of that cut once again, is getting close to that Fed blackout period. So whatever communications we're hoping for guidance going into that decision, the window to be able to get any more of that is closing pretty quickly. But, really it's going to be this week, assessing the data that comes through from the States, seeing what that potentially says about what the Fed should do at this decision. And if it more or less suggests that inflation is reasonably well contained, that perhaps the labour market is deteriorating slightly, that cut's going to be baked in, and that will probably be good for equities if that happens to occur.
So that's the data we're focused on stateside. Interesting also some inflation data out of the Eurozone too. And Christine Lagarde, the president of the ECB, saying, look, they've pretty much got their rates where they want them right now.
Yeah, and the prospect of further cuts in this part of the world certainly seems to be diminishing pretty significantly. So, obviously the big event for this week will be that kind of US figure, that PCE number at the back end of the week, which is expected to show actually inflation on a core basis is pretty much steady at 2.9%, clearly nowhere near where the Fed wants it to be, but not accelerating at all. But, one has to sort of ask the question going into next year, is inflation going to pick up once again? And to what extent are inflationary risks still persistent, especially considering that, in the United States, inflation's still at around 2.9%. Excuse me once again. In Europe, inflation's still sort of 2.3%. Never really got back to target either. And we've got a lot of fiscal spending coming down the pipe. A lot of activity in obviously certain parts of the US economy, for example, that sort of offers the prospect of further demand pull inflation that could, mean things are relatively sticky. And, it does raise a question that, with the rate cuts that are being priced into the market in different parts of the world, whether that's a little bit too dovish and that needs to come out of the markets and be reflected in asset prices. But, more or less, again, as far as Europe is concerned, the rate cutting cycle is all but over. The question in the United States, of course, is, how deep will this rate cutting cycle be? And that's going to be the kind of real volatility driver at the margins, because, my contention would be that, inflation hasn't been tamed and there's still upside risks. That means that, we can't settle that there will be this sort of depth of cuts being priced into the markets, that will actually materialize. And as a result, there is the risk that, those cuts will come out and cause sort of further volatility in equity prices.
And Carl, meanwhile, out of China, some soft PMI figures.
Yeah, and we got more or less, I think, the longest run in terms of a contraction in the manufacturing PMI that we've seen perhaps in history, if not in history, then for a very long time. And really it's telling us nothing particularly new, and I don't necessarily think that the markets will move a great deal on it, other than that, growth in China is practically anemic, and this, very significant slowdown in China's economy continues to play out. And it kind of raises questions about the strength of Asian equities in particular, given their sort of cyclicality, and to what extent there is still a strong investment case for a lot of Asian markets, ex-Chinese tech and Hong Kong tech. So it's a sluggish result. Again, it was only slightly weaker than expected, the data that we received. It hasn't manifested in any kind of move in the Australian dollar, for example, at the open. But nevertheless, one that's going to lead market participants to ask the question, well, what further monetary stimulus is there coming down the pipeline in China? What further fiscal support can be provided from central authorities to try and, improve the outlook for China's economy? Because ultimately, it's still basically moribund and very much raises doubts about whether that kind of 5% growth target is actually achievable or not in China.
Now, meanwhile, on the commodities front, Kyle, OPEC Plus meeting on Sunday deciding to keep their output levels unchanged.
Yeah, and we've likely to see a little bit of chop at the open for oil prices. Not that this move was expected, entirely unexpected, but there is the sense from recent communications from OPEC that it was up until quite recently forecasting that there should be a slight supply deficit going into 2026 on this assumption that global growth would pick up a little bit more than it has. China's probably a part of that story too, obviously, because of its industrial activity being sort of relatively weak and manufacturing activity being relatively weak. But that language has shifted over the last couple of months, in the latest sort of demand and outlook report, suggesting that, the conditions into next year would result into sort of a more sort of balanced market, which, with where we were in the oil market, it was sort of the read through there was that this kind of glut that was developing, as it has to be said, OPEC was increasing supplies over successive months, would only get worse and put downward pressure on prices. So there seems to be now a desire from OPEC to kind of keep the price of oil fairly stable where it is at the moment, to try and pull back on what could have been or was what was believed to be further output hikes going into 2026. And it just kind of give you a pretty strong indication of where OPEC wants the oil price. Not so far high, so not so high into the 60s that perhaps it starts to run the risk of ceding market share, because that's when a lot of US shale producers and stuff like that, their break-even prices are sort of in the high 50s to low 60s, but not so low that it starts becoming an issue from a revenue perspective for a lot of these oil exporting countries. So that sort of high 50s, low 60s mark seemingly is where OPEC would like to price. It kind of does that sort of performs that role of like I said, sort of supporting the aspirations to maintain market share and elevated prices. And it's probably a positive thing for sort of oil bulls that we're seeing a much more assertive OPEC, much more conscious of putting a baseline under prices.
And meanwhile, Kyle, among precious metals, silver at a record and gold continuing its ascent.
Yeah, and I think after we saw that kind of blow off in October, which was, starting to look very much like a manic market there for a little while, we're showing that fundamentally the markets are still, very bullish on precious metals. Generally speaking, I would argue that that's almost going back to what we were talking about before in terms of inflationary risks. Kind of corollary of that, which I've kind of named the run at hot trade, which is to say that there are inflation risks still coming down the pipeline because of, interest rate cuts coming in an environment of still elevated inflation, plus all the fiscal spend that's coming down the pipe in 2026 from governments across the world, that people are looking for non-fiat diversifiers, and that's coming in the form of precious metals. But of course, for the silver dynamic, it's got the interesting element too of that kind of industrial application. One thing that sort of compounds that dynamic is that a lot of that fiscal spend that is raising fears about, perhaps currency debasement and what have you too, is actually being directed into areas of the economy, chiefly AI infrastructure, other kind of infrastructure associated with electrification, all these sorts of things, that basically uses silver as a fairly critical input, not vital but fairly critical input, and that's also adding to that kind of outperformance in the silver price. So it's at sort of $53, $54 at the moment, looking fairly well supported. And again, notwithstanding this kind of little blow off that we had when the markets became a little bit manic, the trend still seems very strong for gold and of course silver. And there really does seem to be a fairly significant tailwind to both, especially silver, to keep the price perhaps moving higher.
And Kyle, just very quickly, locally, look, we do get a read on economic growth this week and GDP numbers. Also, perhaps a focus on the Aussie dollar. It's back up to about 65.5.
Yeah, certainly. And I mean, obviously, with the inflation data that we got last week, there is the view now that, in fact, the next move from the RBA, and this is what's being baked into interest rate markets, could actually be a hike somewhere, not in the too distant in the near future, I should say, but that'll be the next move sort of down the line. There is also the hope that really some of the rate cuts that we've already seen, and maybe some of the slight improvements in the last quarter or so in the global economic backdrop as we move past this trade policy uncertainty, means that the GDP figures might be a little bit better than previous ones in Australia. So probably won't shift the dial too much when it comes to monetary policy expectations, because inflation is the critical issue at the moment, but still one that could sort of shift expectations at the margin of whether there'll be any further cuts to come, or perhaps indeed, as the rate markets are pricing in at the moment, that where the conversation is actually going to start moving now to when the RBA may need to sort of raise interest rates very slightly once again.